If you haven't heard of SPMO yet, it's one of the best growth ETFs on the planet because it has higher highs than some pure technology funds while having less drawdowns than even things like the S&P 500. So it's essentially a cheat code. It's very, very good in up markets, and then in down markets, it's dropping less than most of those other growth or foundational ETFs. Well, it just recently changed up completely, and so I'm excited to show you what exactly happened there, but more importantly, and I'm going to tell you what I think about it. Interestingly, I made this back test based on the past decade, and these numbers blew me away. I made a sample portfolio that most financial advisors would agree is very diversified and not too aggressive. It has 48% US stocks in the total US stock market, VTI, then 8% inch real estate, VNQ, then 24% inches international with VXUS, and then a nice conservative position in 20% bonds, BND. The next portfolio was just fully SPMO, and then the last portfolio was just fully the S&P 500. Look at these results. Blue's the diversified portfolio, green is SPMO, and gray is the S&P 500. They started off pretty similar for a little while, and they even moved moderately similar, but SPMO really picked up there in the middle and just never looked back. Look at that outperformance. $10,000 invested in each one ended up with the more diversified portfolio. We're at only $24,638, the S&P 500 at $35,471, and then SPMO at $48,778. Now, that's awesome as far as how much it gained in the past 10 years, but still, some people would say, well, that diversified portfolio is actually safer. It's probably going to do better in a recession or in times when the market's dropping. That one's probably going to drop the least, especially because that one had some bonds in there, and that's supposed to stabilize the portfolio. But look at this. The worst year for each of these portfolios, SPMO won by a landslide. While each of the other two fell by minus 18% and 17%, the worst year for SPMO was only minus 10%. And then the best year, diversified portfolio was 24%, S&P 500 was 31%, and SPMO was almost 46%. Why does SPMO win? SPMO isn't trying to predict the market. It simply owns what's already winning. That's historically one of the most powerful strategies in investing. Remember that all investing carries risk, so do your own research. This is not financial advice, and I'm not a financial advisor. So this is what the top 15 holdings look like the past 6 months, but since SPMO does a huge rebalance every 6 months, a lot has changed. Remember that momentum is one of the most proven market factors. Momentum investing comes from academic research. The idea is that stocks that are already performing tend to keep outperforming. So why does this actually work? Institutional money piles into the winners that are already happening. Trends persist longer than people expect. And human psychology, like fear and greed, drives continuation. Historically, momentum has done much better than the broad market over long periods. It's considered one of the core factors alongside value and size. SPMO automatically rotates into the strongest stocks in the S&P 500. It cuts losers, adds winners without you doing anything. So here's the new changes and what the top 15 look like now. So remember, in its last version, we had some Broadcom at the top, NVIDIA, Meta, JP Morgan, and Palantir. Those were the biggest things. Now, after the reconstitution that just happened, here's the top 5. So we have NVIDIA at 9.23% and Broadcom's at 7.19%. Now we got a new top 3, Micron, a new top 4, Johnson & Johnson, a new top 5, Google. Rounding out the rest of the 10 is Exxon, Google, which makes it more like 9%. So if you really look at the amount of Google that's in this now, it's actually at second position. Then we got Lam Research Corp at 3.4%, Caterpillar at 2.7%, and AMD at 2.13%. Now, you can go on the website to get the entire holdings, and so you can see it here. Just like I showed you before, here's the top 10, and we got RTX, General Electric, Palantir still in there. It's just at a much smaller amount at 1.87%. Some other notable names that I like that are in there would be Applied Materials, Seagate Technology, Lockheed Martin. I also really like that Monster Beverage Corp is in there. I've been looking at them and their numbers have been pretty outstanding. There's also some Robinhood and then a small amount of a lot of these. These are almost insignificant positions, right, but that's what we have in there. So if we look at the old top 15 there, and then here's the new top 10. You can see some pretty notable differences, like I said. One big one is just that Broadcom's a little bit smaller. The other huge one is the fact that there wasn't any Google in this top 15. And now, like I said, there's 3.9% and 5% here, which comes out to just about 9% of the entire portfolio, putting it at number 2. So instead of it being Broadcom and NVIDIA, now it's NVIDIA, Google, and Broadcom. Between just those names, it's a little over 23% of the entire portfolio for just those three. Once we add in Micron and Johnson & Johnson, we're up over a third of the entire portfolio just in the top 5. Now, I do wish that in this new SPMO, we still had some Meta, but it actually looks like they deleted it totally. I'm not too happy about that. I do like Meta. I think Meta's price right now is quite a steal, but I do understand this is a momentum style ETF. And so maybe for these next couple of months, they're still going to be getting some things together. And eventually when they're back on the rise, they're going to add that Meta back in and they'll have them in the portfolio when things are going well. And I'd love to hear from you. What's your biggest takeaways here? What do you wish that was in the fund? What are you happy about in the new fund? Go ahead and comment that down below. Now, remember, SPMO is built to outperform in very, very solid bull markets because in strong markets, it's going to overweight those top performing stocks. These stocks often are the ones that are driving all of the other ETFs. And those couple of stocks are the ones that are making that ETF go so high up. In long bull runs like 2010 to 2021, and then like 2023 to now, momentum strategies often beat the S&P 500, like I showed you from before in that back test. But this matters for forever investing. Most of your lifetime returns come from a few big runs. And this ETF's built to capture those runs better than average. One other very important thing that SPMO does is it takes away one of the biggest weaknesses in investing. Honestly, that's taken away you. Most investors don't perform because of bad investments. They usually underperform because of bad behavior. Studies show that the average investor does worse than the overall market by 2 to 4% per year, basically because they just panic sell or they have emotional decision making. Momentum investing helped close that gap by enforcing discipline. SPMO has rules-based rebalancing. There's no emotions, there's no guessing. It's just all on an algorithm of whatever's doing very, very well. And whatever's been doing very well right now in the very short term, they just pile more into that because it's probably going to continue, at least in the short term. Now, long-term investing, if you're buying these certain positions very well or have had a big run up, it's not the best way because eventually you're going to have to sell out of those positions to get into new ones. But SPMO does that for you so you don't have to be as hands-on. And their timing is perfect. And it's every 6 months they're doing a rebalance just like they just did. Now, even though, yes, this is a very powerful way to invest in. This ETF is very powerful, especially in bull markets. SPMO can underperform in choppy or in tough times. It can be more volatile than the regular S&P 500, especially month to month. When we look at it year over year or decade over decade, SPMO definitely outperforms and has been outperforming. But when you look at it just month to month, sometimes SPMO could be down more. As of right now, this year to date, SPMO is down almost 4%, which is one big reason I've been buying heavily this year. Like I'm buying double right now. I believe in this fund long term, so I'll be buying heavy all year. But there is actually a very specific way for you to add this into your portfolio. And it has to do with you specifically. It has to do with your goals, your risk tolerance. What else are you investing in? has to do with your time horizon. There's a lot of very big particulars, and it's hard to generalize on a video like this. Everyone's different, which is why you may want to check out this ETF cohort group that's closing soon. Now, SPMO works best with long-term discipline, which is why it'd be great to add to this 3-fund portfolio that I go over in detail here and tell you not only what the 3 funds are, but also what percentage you should be in each category based on your age. Or watch this one to keep you going strong in investing. If you found this video valuable, please hit the like button and subscribe to my channel. Don't forget to write your suggestions on the comment below.